Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Liberty Energy Inc. Annual Report. Liberty Energy Inc. is a leading integrated energy services and technology company that provides a wide range of businesses and services to the oil and gas industry. The company's offerings include hydraulic fracturing services and related technologies for onshore oil, natural gas, and enhanced geothermal exploration and production companies in North America. Some of the key services provided by Liberty Energy Inc. include wireline services, proppant delivery solutions, field gas processing and treating, compressed natural gas, CNG delivery, data analytics, and logistics software. The company also offers related goods such as sand mine operations and technologies, including proppant handling equipment. In terms of geographical presence, Liberty Energy Inc. operates in several major basins across North America, including the Permian Basin, Williston Basin, Haynesville Shale, Eagle Ford Shale, Denver-Julesburg Basin, Western Canadian Sedimentary Basin, Powder River Basin, Appalachian Basin, Anadarko Basin, Uinta Basin, San Juan Basin, and Beetaloo Basin. The company has a significant fleet of hydraulic fracturing equipment, with approximately 40 active units as of December 31, 2025. Additionally, Liberty Energy Inc. owns 2 sand mines in the Permian Basin, further solidifying its position as a major player in the energy services industry. Liberty Energy Inc.'s LBRT stock price has experienced a significant surge in the past year, increasing by over 45.68%. This remarkable growth can be attributed to several key news events that have positively impacted investor sentiment. One major contributor was Liberty Energy's strong fourth quarter 2025 financial and operational results, which exceeded expectations despite a decrease in net income and revenue for the full year 2025 compared to 2024. The company's revenue for Q4 2025 reached $1 billion, marking a 10% increase year-over-year and sequentially from Q3 2025. Another significant catalyst was Liberty Energy's upbeat business outlook, particularly its expansion into power solutions. The company unveiled an accelerated plan to deploy 3 gigawatts (GW) of distributed power projects by 2029, including a 1 GW power development agreement with Vantage Data Centers and a 330 MW power reservation and preliminary energy services agreement with a leading data center developer in Texas. Additionally, Liberty Energy demonstrated its commitment to returning capital to shareholders through increased dividends and share buybacks. The company raised its quarterly cash dividend by 13% to $0.09 per share, effective in Q4 2025, and repurchased approximately 1.55 million shares of Class A common stock throughout 2025. The positive sentiment was further reinforced by analyst upgrades and price target revisions, with several financial institutions upgrading their ratings and raising price targets for LBRT stock. These combined factors have contributed to a notable surge in Liberty Energy Inc.'s stock price, making it an attractive investment opportunity for investors seeking growth and returns. Liberty Energy Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Liberty Energy Inc. trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 2.04 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into 2 main categories: internal factors and external factors. Internal factors contributing to revenue growth include the introduction of new technologies, such as Tier II dual-fuel technology and quiet fleet technology, which have increased efficiency and reduced costs. The company's ability to execute on new business and manage costs effectively has also been a key driver of growth. Additionally, the expansion into new lines of business, such as distributed power generation, and the diversification of revenue streams through long-term partnerships with customers have contributed to revenue growth. On the other hand, external factors contributing to revenue decline include reductions in capital spending by the oil and natural gas industry, volatility of oil and natural gas prices, and delays or restrictions in obtaining permits for operations. The increased societal and governmental focus on ESG and climate change issues has also led to a decrease in demand for certain services. Furthermore, technology advancements in well service technologies have made some services less necessary, while geopolitical conditions and uncertainty in global financial markets have also contributed to revenue decline. The company's ability to adapt to these external factors and maintain its market share will be crucial in determining future revenue growth or decline. The company's net income experienced a significant change between 2024 and 2025. Initially, it decreased by $168.1 million from $316 million to $147.9 million in 2025 compared to the previous year. However, upon closer examination, we see that there was also an increase of $300 million, 33%, in net income for 2025, accompanied by a 1.8 percentage point expansion in profit margins. The decrease in net income can be attributed to increased costs, delays or shortages in materials, and regulatory changes. On the other hand, the increase in net income is due to an increase in other income, net, and a decrease in income tax expense resulting from lower net income before taxes and higher U.S. federal tax credits. In terms of profit margins, there seems to be conflicting information. Initially, it appears that profit margins decreased from 7.33% in 2024 to approximately 3.69% in 2025. However, a closer look reveals that profit margins actually expanded by 1.8 percentage points from 10.5% in 2024 to 12.3% in 2025. This discrepancy highlights the complexity of the company's financial performance and the need for careful analysis. The company's operating cash flow has been a subject of concern in the past. According to the extracted summaries, for 2 consecutive years, as seen on pages 47 and 50, the company was struggling with negative operating cash flow. This indicates that the company was not generating enough cash from its core operations to meet its financial obligations. However, there is a positive note on page 64, which suggests that the company has managed to turn things around and start generating positive operating cash flow. This shift in trend could be attributed to various factors such as cost-cutting measures, improved efficiency, or increased revenue streams. The fact that the company was able to break even and eventually generate a surplus of cash from its operations is a significant improvement. The company's debt level has undergone significant changes over the past year. Initially, the revolving credit facility stood at $275 million as of December 31, 2025. However, this amount increased to a maximum of $750 million under the same facility. Additionally, the permitted bridge indebtedness was introduced, allowing for up to $600 million in debt. The long-term debt also saw an increase, with $116.3 million payable within 12 months and $231.2 million payable thereafter. In terms of interest expenses, there has been a notable rise. Interest expense, net, increased by $7.6 million primarily due to the addition of finance lease liabilities. Furthermore, interest expense has seen a significant jump of $8.092 million in 2025 compared to 2024. The net cash used in financing activities decreased by $35.16 million, with interest expense being one of the contributing factors. Overall, both debt level and interest expenses have increased significantly over the past year. Management is optimistic about the company's outlook, citing several key factors that will drive its performance. The company's success will depend on global economic conditions, oil and natural gas demand and prices, as well as the outlook for the power industry. To stay ahead of the curve, management plans to focus on technological innovation, particularly in completion complexity, where they remain proactive in developing innovative solutions. The company is also shifting its emphasis from diesel to cleaner natural gas, investing in cutting-edge technologies such as DigiFrac, DigiPrime, and LPI power solutions. This move towards sustainability is expected to drive efficiency gains in oilfield drilling activity and increase the complexity and intensity of well completions. Furthermore, management sees a growing demand for distributed power solutions due to underinvestment in grid infrastructure and transmission constraints. Overall, management's strategy is centered around embracing technological innovation, prioritizing sustainability, and driving continuous improvement. By staying ahead of industry trends and adapting to changing market conditions, the company aims to capitalize on emerging opportunities and maintain its competitive edge. The company's financial activities have been notable over the past year. One significant development is its dividend payments. Since December 2022, the company has consistently paid quarterly cash dividends to its shareholders. This demonstrates a commitment to returning value to investors. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it has repurchased shares, indicating an effort to reduce the number of outstanding shares and potentially boost earnings per share for remaining investors. The scale of these activities is substantial, with $104.4 million worth of shares repurchased in 2024 alone. There are concerns about inventory buildup or supply chain disruption that could impact the company's operations. Delays in deliveries from third-party suppliers, potential shortages of materials, and backlogged ports and trucking shortages have been identified as potential issues, page 28. Additionally, unavailability of necessary equipment due to capacity constraints, labor shortages, and supplier product quality issues may result in lengthy delays, page 29. The company also faces concerns about excess inventory and equipment due to oversupply, limited supply for certain inventory and equipment needed by the distributed power business, and long-term purchase commitments with vendors that may be less favorable to the company, page 30. Inventory buildup is specifically mentioned as a concern on page 52. Furthermore, supply chain disruptions are also mentioned in other pages, including concerns about sand supply issues from third-party providers and downtime resulting from these issues, pages 4 and 27. The financial impact of these concerns is evident in the decrease in EBITDA by $204,706,000 and adjusted EBITDA by $287,447,000 due to borrowing base limitations based on a percentage of eligible inventory, page 47. These disruptions could have significant consequences for the company's operations and profitability. That concludes the financial summary for Liberty Energy Inc. Feel free to comment below, and I will be happy to answer them when possible.